A very good morning and a very good afternoon to all our guests joining us from India and the UK. I'm Anita Nandire and I represent the City of London Corporation based here in Mumbai. I'm very pleased to welcome all of you to this official launch and discussion of the first report developed by the City of London India UK Capital Markets Working Group. Let me quickly take you through the agenda. We will begin by the report being officially launched by Ms. Catherine McGuinness, who is the policy chair at the City of London Corporation. This will be followed by a quick perspective of the key findings of the report by the two co-chairs. The India co-chair is Mr. Ananth Narayan, who's associate professor at the SPJIMR Institute of Management and Research, and the UK co-chair is Mr. Shrey Kohli, who is the head of debt capital markets and funds at the London Stock Exchange. After this, we will move on to the panel discussion, which is namely Indian corporate debt market and the roadmap ahead. And we'll finally have the concluding remarks from Joy and Matthew of DLA Piper. So that is the plan for this afternoon. And we would request all the members of the audience to please post their questions on the chat option, which our moderator will pick up during the panel discussion. So with that, I would now like to invite Ms. Catherine McGuinness, Policy Chair of the City of London Corporation, to officially launch the report and give the opening remarks. Over to you, Catherine.
Thank you very much, Anita, and a very warm welcome from me to all of you, wherever you are joining us from today. It's a real pleasure to welcome you all to this event. As you've heard, I'm Catherine McGuinness. I'm the Policy Chair at the City of London Corporation, the organisation which looks after the Square Mile itself, but works very closely with the UK's financial and professional services sector. And actually, I'd just like to start by saying on behalf of the City Corporation that our thoughts and prayers are with the people of India at this moment as we continue, as you continue and we continue the global fight against COVID-19. What extraordinary times we have all been living through. But today we're launching the first report of the India UK Capital Markets Working Group, Unleashing the Potential of Indian Debt Capital Markets. And I'd like to thank the working group and particularly its co-chairs, Shrey, Kohli and Ananth Narayan, who we'll hear from in a minute, for all their work and commitment in producing this report at this unprecedented time. We're shortly going to hear about the findings of the report, and then I'm sure we will have a fascinating discussion from our expert panel. But before I hand over, I just want to say a few words about the working group and about the purpose of today's report. I had the pleasure of launching the working group last year, building on a long history of close collaboration between India and the UK, and indeed a long history of work from the City Corporation in trying to strengthen those links. And it's been great to see the progress of the group since then in meeting its ambitions to break down market and policy barriers impeding growth, and to examine trends in capital markets development and look at how we can create a platform to tap global, long-term, low-cost pools of capital from sovereign wealth funds and identify what is needed to encourage the development of a vibrant capital market in India. We were delighted that the group received recognition in the last Economic and Financial Dialogue joint statement by the UK Chancellor and the Indian Finance Minister. And today's report is a key part of this work. It's the first in a series of working papers. We know that capital markets provide a really important channel of financing for the real economy, helping to allocate risk and, crucially, supporting economic growth and financial stability in India and worldwide. And this report comes at a particularly important time as we face the economic challenges ahead, and not just the economic challenges, but also the significance of meeting the climate challenge. This provides a comprehensive look at India's debt markets, provides recommendations encouraging the further development of a vibrant capital market in India, increasing the depth of its corporate bond markets and enabling India's continued growth. Its findings will form an integral part of the forthcoming financial markets dialogue. India's capital markets represent a clear opportunity, and we believe that the City can add value to the existing work in this area by drawing on our network to help provide a global network. And using our networks, we'll be sharing the outputs of this group with UK and Indian policymakers and private sector stakeholders with a view to driving forward policy challenges and policy changes that would strengthen India's corporate bond markets and reduce some of the barriers to drawing in more finance. I should say I've just come from hearing our Chancellor of the Exchequer, Rishi Sunak, speak at the Mansion House, launching a new chapter for a new vision for the financial services sector of the UK. I spoke to him about the launch of this report. He was very interested to hear that we would be doing this, and he has, in a chapter which he himself has published this morning or launched this morning, it mentions the importance of strengthening our relationship and our financial services connections with India. So we look forward to working on that agenda with him and working closely with partners in India on this and many other shared priorities. So without more ado, I am going formally to launch the report. You will all get a link to it later. I'm going to launch the report, delighted to do so, and hand over to the co-chairs, Shrey, Kohli and Ananth Narayan, to tell us more about it. Thank you very much. Over to you.
Thank you very much, Catherine. And on behalf of the Capital Markets Working Group, may I welcome you all to today's launch webinar, which both Ananth and myself are very excited to do. There was a point, I believe, back in April where we were ready to launch the report, but to Catherine's point around the great situation that I think all of us were going through globally, we decided that we would actually take some time to recognize the difficult circumstances faced by everyone, and also take some time to get some further market soundings on the recommendations that the working group had worked on, and consider launching the report at an appropriate time. We think now is an appropriate time, particularly in the lead up to the India-UK financial markets dialogue, and therefore we're keen to present the recommendations of the report here to do with our expert panel. So I think in today's introduction, rather than go through the recommendations specifically, which we'll go through later, I just wanted to give the audience a sense of the work that we've done and how it's additive to previous body of literature which exists. So the working group, which consists of very practitioner-led view. We had investors, issuers, legal advisors, tax advisors, macro experts, and people from the market infrastructure industry. We're keen to add on to previous reports, including the HR Khan Committee report of 2014 and the India-UK Financial Partnership report of 2015 and previous bodies of work by the City of London. So what we did is we broke ourselves up into 3 separate working groups and looked across a few issues. The first of all was the context of the efficiency of the operation of onshore and domestic markets, which Ananth very capably chaired. The second was the way that issuers have the ability to tap international markets and international investors have the ability to tap paper issued by Indian corporates, which I chaired. And a third working group which looked at an ecosystem of products that requires to support markets both internationally as well as domestically. So a set of cross-cutting issues. And based on that, and a number of vociferous debates that we've had, some areas where we agreed in unanimity, some areas where different perspectives of practitioners came together, we've set 15 recommendations, which we also had to whittle down. These recommendations focus on the efficiency of primary debt markets, liquidity within secondary markets, the ecosystem and market infrastructure for products that exist to support corporate debt markets, as well as tax and regulatory issues. And thematically, one of the areas which also came out during the report, which is key from the recommendations, is the importance of ESG and sustainable finance, given the context of building back better within the post-pandemic world. Now, we strongly believe that public markets are key to driving growth and job creation, and we think the robustness of Indian debt markets would certainly be able to power sustainable infrastructure. And we look forward to engaging in policy discussions with policymakers including the RBI, SEBI, IFSCA, and during the financial markets dialogue. Ananth, I'll hand over to you.
Thanks a lot, Shrey. I think you've covered the opening extremely well. I'm not going to add too much. Just want to re-emphasize that the group of people who are part of this working group, an eclectic bunch of practitioners, as Shrey rightly mentioned, representing all sections of stakeholders. And to that extent, what you're seeing is a very practitioner-led set of recommendations. Now, I know that when we talk about capital markets in India, debt capital markets, improvement, secondary market trading, etc., there is inevitably a sense of rolling your eyes because we've heard this before, we've seen this before. And God knows when I had a lot more hair on my head, we were still working on improving capital markets. What I like about this particular report, as Shrey mentioned, it builds on some of the outstanding recommendations from the previous reports, including the Khan Committee report. So it sort of picks up those parts which are still yet to be completely implemented. And it adds a few extra suggestions which came up from the working group, which I'm sure will get discussed in the panel discussion subsequently. All of which I think make a lot of sense. The strong sense that we had in the working group was the iron is hot right now. The events of what happened last year around the instability in the markets for a period of time, and the desire and the aspiration that India should become a $5 trillion economy clearly augurs well for the next round of developments, as Shrey mentioned, on various areas, whether it is primary markets and primary issuances, secondary market debt, the ecosystem of products which are made available, the regulations, including the tax regulations and the regulations from the respective regulators which need to be changed. Plus, of course, the international angle of how global investors can be drawn into the India growth story. I think this is the right time to push that agenda again. My strong recommendation to everybody, do go through the recommendations, even if you disagree with them, and please do your bit to spread the word around with the relevant stakeholders. Even if 60–70% of the recommendations get implemented, I think our capital markets will be well on our way to funding India's growth aspirations and growth potential. I'll stop there. I'll hand it back to Anita and to Krishna from Shrey and myself. Thank you.
Thank you so much, Ananth and Shrey, for that very comprehensive overview of the recommendations. May I request you all to be online whilst I introduce the rest of our esteemed panel. I'll do that alphabetically. Our first panelist is Mr. Jayesh H., partner and co-founder at Juresco. Then we have Ms. Lakshmi Iyer, president and CIO debt and head of products at Kotak Mahindra AMC. Mr. R. Govindan, executive vice president, corporate finance and the chief risk officer at Larsen & Toubro. Dr. Srini Sundaram, founder and CEO at Vesto Limited UK. Ladies and gentlemen, I'm very happy to introduce you to Ms. Krishna Merchant, from Asia Credit, who's the Asia Credit correspondent at IFR, which is a Refinitiv and LSE business group. So over to you, Krishna, with that.
Hello, everybody. Welcome to this panel discussion. We'll start with the primary bond market in India. The primary bond market we have seen has evolved in the past few years. The electronic bidding platform was introduced about a few years back, and most issuances happen on that platform. And the size of the issuance has to be around ₹1 billion. So there are some recommendations regarding development over there. This question is for Mr. Govindan. How important is it to have the concept of anchor investors to be introduced in the electronic bidding platform for the primary bond issuances? Mr. Govindan, you need to go on mute.
You can hear me?
Yeah, and if you can turn your video on.
Yeah, I think it is important to have the role of anchor investor. If you look at how the equity markets have evolved, is that I think equity market, though it is wholesale and retail both together, the concept of these anchor investors have played a big role in ensuring the capital required when you do a IPO or subsequent capital raise, you are able to access the capital because the the person who's raising the money and the person who's giving the money is all broadly global, in the sense that a Indian company gets access from so many other places as well. So this conduit is important in terms of the connectivity. And there is a concept which is there in the equity markets in India. If you go back to the regulation of electronic bleeding platform, quite a lot of this is essentially had with see, it has got quite a lot of public sector mindset in the way I think some of the public sectors, both investors and issuers, they may like the platform because they can prove that, it is a transparent market because you just put the bid and it happens there. I think some of the events where some mis-selling may have happened, some small little things may have happened earlier. I think that has played a role in this familiarization of the electronic bid platform. Earlier, we used to have a private placement market, which used to be very active. Today, what we find is there is no certainty. See, the basic challenge in not having anchor investor is that there is no certainty either to the issuer or to the investor. And a lot of time goes in explaining, and the intermediary, the banks who's intermediating this, plays a lot of role in talking to the investors about the issuer, and provides a great platform, and they bring the whole system together. So this concept of anchor investor today in the electronic bleeding platform is like a fastest fingers first. You just you say I'm issuing. Some 200 people get access to the information. The exchanges do it, and then on the day, that 1 hour when you start the platform, just press it first. Whoever gets it first, it becomes more like a game rather than anything else. The relationship between the issuer, the underwriter, even underwriting maybe should be allowed, should be possible. Maybe you can have some rules for underwriting. It's possible to do that, but the role of anchor investor is important because that is what brings certainty. And larger the company grows, the certainty is valued quite a lot. It is important that we continue with that process. This process is very comfortable for public sector issuers and public sector investors. Private sector people who have a role, foreign institutions, for the companies who are based in India or foreign companies who are based in India, they would always prefer a system where they are able to have a bit more relationship building and have that consistency in raising capital. Today it's like a heartless situation. Just put on the bid. If you like the interest rate, like many cases I have seen, there is hardly any interest because there is no marketing. There is not much of discussions have happened, with the result that many transactions have not happened. We have seen it ourselves in some of our group. So it is important that anchor investor as a concept exists. Private placement as a concept. You may have double platforms. You can have the electronic bidding platform for public sector. You can have a slightly different system where the anchor investors are there. That is what relationship building is all about, and institutional, and people will know it is not a retail product. The debt market is definitely not a retail product at the issuance level. So it's important that anchor investors kept in mind. It brings a lot of certainty to lots of institutions, and the intermediary plays a big role in getting that process. Otherwise, it becomes like a heartless operation where you just press the button, you may get it, you may not get it, and many times you won't even know whether to press the button or not because you may not even be aware. There is nothing like pre-marketing which happens before. So we think it is important that the role of intermediation exists. You may have some rules of the game for that, but it is important that it exists. It has not been very super effective, is what I feel.
Thank you,
I think it is important. We need to.
Thank you, Mr. Govindan. So as you pointed out, the role of anchor investor is very important. We have seen in the past some of the deals in the, some public sector deals actually get scrapped because they did not get the fine price. So hence anchor investors become very important. Moving on to the secondary bond market, we have seen ripple effects on the secondary bond market, especially during the times of risk aversion, only a couple of years back, we saw few non-bank lenders, as they defaulted, the bond yields spiked, not just for those defaulters, but for other normal corporate bonds as well. And also when a large mutual fund, there was a liquidity crisis over there, we also saw a ripple effect on the bond market. Hence, the secondary market liquidity has become a very important issue in India. So to address that, I'll go to Mr. Jayesh. What are the important legislative changes needed to allow RBI to accept corporate bonds as a collateral for liquidity adjustment facility, for repo, reverse repo operations, and how can the regulators and FSDC intervene in the corporate bond market?
Thank you for that. Okay, the key change has to be to the Reserve Bank of India Act. For whatever reason, when the definition of the term repo, reverse repo was introduced, it refers to securities issued by the government of India, by the state governments. And interestingly, it even captures foreign securities with no qualification on what subset of foreign securities. So you could, strictly speaking, today, as we speak, RBI can do a repo or a reverse repo involving a foreign security, but it cannot do so involving a corporate bond. I mean, there is another provision of the RBI Act which talks about, this National Industrial Credit Long-Term Operations Fund, where again RBI has a wide power to put in whatever funds it wants into that, and then buy, fund market participants. But there again, it is restricted to certain type of state development financial institutions like Exim, SIDBI, etc., and bonds issued by them. So the challenge really is that corporate bonds outside of sovereign-owned enterprises issued bonds. Today, the legislative framework does not explicitly enable Reserve Bank of India to do those repos. And knowing the Reserve Bank, I think they would want that absolute legislative clarity that they can indeed do these corporate bond repos, and without which they may not want to venture into that. So I can very well understand why they haven't done it so far. As in not done the market operations. And this is something I would expect FSDC to take up and recommend that legislative amendment be made at the earliest. And then, we can have a positive development there. But if I may make a connected point, and one of the recommendations in the report is this coordinated efforts between the regulators, and not just coordination between the regulators. It's a bit like, Caesar's wife has to be seen to be above suspicion. If I apply that in the reverse, the market needs to see that the regulators are regularly coordinating, and market needs to get that comfort. These are not regulators who are more behind the doors. Coordination is a great thing, but publicly also, and making the right noises, because there is rightly or wrongly a sense in the market that there's a bit of a domain issues going on, and okay, RBI has a repo facility, but only for government securities. So let's have some other regulator set up a fund and a repo facility involving corporate bonds and so on. So I don't think market gets confidence from that. In fact, it makes, and I'm not just talking about the domestic investors, but the global investors, which are becoming increasingly relevant for the domestic market, they get sort of a little nervous on this. It doesn't send out the right signs to them. So to sum up again, my point really is, besides a legislative change which is required, we need a greater public, coordination effect from the regulators. Thank you, Krishna, for this opportunity.
So as Mr. Govindan pointed out, we obviously need to enlarge that only repo transactions don't happen for government security, but for corporate bonds as well. And there has to be coordination happening between the different regulators. So moving on to Lakshmi, what is the best way to ensure that investors remain protected, especially when we have seen bond yields spike, very sharply up in India in the past couple of years? And how important is it to have the market makers intervene in the market? And should the issuers as well be encouraged to appoint market makers? What are your thoughts on that?
Krishna, if I had a magic wand and every time interest rates went up, I would tell investors that, look, I have this magic potion. I just mix it into the fund and it will not let the NAVs go down. I think I would be the most astute manager on street. But unfortunately, that's not possible. So I think the next best thing that is possible is in a market like this, there are hedge mechanisms which work. And mutual funds, for example, are not allowed naked shorting. So you can just run a portfolio, you can't leverage, so you can't go beyond 100 rupees. But certainly that pool of 100 rupees can be protected, and which is where the hedge mechanisms come in. Now, there are two sorts of protection which one can seek for an investor. Clearly, one is against rising interest rates, and second is against any credit event. Unfortunately, or fortunately, right now, we have one leg of the market which is reasonably well developed, I would say, which is the interest rate swap market. So if you have a view on interest rates, positive or negative, you can actually use that to make suitable modifications to your portfolio. The credit default swap market, unfortunately, is still not as robust or as buoyant. It's nowhere near. So just do this. Go to a CCIL India website where the bonds trade. Go click on IRS, which is the interest rate swaps, and you can see vibrant activity happening. Just click on the CDS, you don't see anything yet happening. So that could be one added layer which could get introduced at a point in time, because in the series of events that have hit the bond market, specifically the credit markets in mutual funds, and of course the current pandemic situation, this works as, I would say, a great Brahmastra, or at least a tool for a hedge mechanism, and that gives a lot of confidence to the investors. So yes, right now there are reasonable hedge mechanisms for on the interest rate side, and while that does not assure anything, in terms of returns, or does not assure you a positive return, it certainly reduces the impact quite significantly. On your second question, is it important to have market makers? Our thoughts are that if there is a market, there has to be a market maker, period. There is no two ways about it. Let's talk about government bonds. Yes, is there a market making activity, pseudo or otherwise? Yes, there are primary dealers who are actively doing these trades. They also participate in government auctions. They do underwrite these auctions. There it is mandatory. When you flip that to corporate bonds, is it mandatory? Answer is no. Can the bank participate? Answer is it depends on which side of the bed you get up, and then you choose to do it. So it's very, very, very subjective. And in that kind of a scenario, if I superimpose the fact that most of the corporate bond investors are largely buy and hold investors. When that happens, it just kind of restricts the entire secondary market activity. So yes, it is a definite requirement. Contours can be discussed, and we did have these discussions as part of the working group as well. And repo is definitely a small but certain step in that direction. As we speak, even our regulator, which is a SEBI, has been engaging to actually have an LPCC, a limited purpose clearing corporation, where we can actually facilitate this as at the industry level. Corporate bond repo is already there. It's been launched. But yes, the breadth needs to be increased, both in terms of the entities which want to avail of this facility, and obviously the number of participants which are willing to. So I think it has to be an orchestra. Even if one string of the guitar is not functioning, it doesn't create for a great music.
So as Lakshmi has put it so nicely, definitely we need a magic wand, but there has to be in terms of different kind of products that can be introduced to reduce volatility. So yes, develop the CDS market, also allow market makers, and some developments are happening which are moving in this direction. So I'll go to you, Mr. Ananth Narayan. How important it is to introduce these market infrastructure tools, such as bond forwards, allow short positions in the credit market, and even sell protection via CDS. And what is the best and the efficient way to implement these tools?
Thanks a lot, Krishna. Really appreciate, and remind me not to speak after Lakshmi the next time around. She sets a very high standard. No, but look, very broadly, Krishna, what we've tried to do in this report is kind of a belts and braces approach to improve domestic debt capital markets. So you've covered the whole question of issuances and the primary markets, the anchor investor point that Mr. Govindan made. Then we came to the secondary part where we said, listen, every regulator in the world, every central bank in the world gets involved in credit markets. Okay, most central banks in the world get involved in credit markets. Unfortunately, ours don't. So when you have events like you had last March or April, everybody's watching each other as to who's going to bell the cat and walk into the markets and do some stabilization, right, between RBI and SEBI. And the point that Jayesh made, that coordination between regulators is required. So that's the second part. Get somebody who can start doing repos at a regulatory level, and also have somebody who can buy bonds when required. It's absolutely a legitimate operation for financial stability. And hopefully that the backstop facility that has been talked about in the budget will come through. So that's the second part. The concept of market makers that Lakshmi spoke of is again the third part of that, which is let's have formal market makers, make it profitable for people to come and make markets, get appointed by issuers, get a fees, and provide some kind of depth. I think the next level is getting more widespread popularity around corporate debt. I'm willing to bet that barring a few tax-saving bonds, none of us really hold corporate debt in our demat accounts. Simply because A, they're not popular enough as in the case of equity, and B, the taxation requirements for holding direct corporate debt is quite onerous. So again, the next part about popularity is let's have some kind of uniformity in the tax treatment for debt and for equity. By the way, bring debt down to equity. Don't take equity up to debt. That's the whole point. And make an equilibrium between investing through directly in debt and through funds. So that's the next part. The last part is exactly what Lakshmi said, and to your question, Krishna, which is, look, along with all of this, you also need belts and braces in terms of market products and market infrastructure. You need, for instance, things like a shorting ability or a CDS market where investors can buy protection if they happen to get into a particular position and they're not able to get out of it and they want protection. So something like a CDS market has to develop. Now, what are we suggesting there? We've been talking about CDS for the last 100 years. What we're suggesting is end users, including people like Lakshmi, should be allowed to sell protection on the back of them holding government bonds, which means they actually create synthetic bonds as a combination of holding government paper and selling protection. You need end users to be able to sell, not just buy. So that's the recommendation we've made. Likewise, Mr. Govindan came with this very good idea of encourage trading in credit indices. Just as you have Nifty futures or Sensex futures, you also say, let's build some indices which capture credit spreads, and let's build some popularity around that. Bond forwards is a critical requirement for people like insurance companies because they know what cash flows they're going to get over a period of time. They would like to lock into those rates today for remove the reinvestment risk. And by the way, a bond forward is a combination of a bond purchase and a repo. And if you want depth in repo, here is a great way of getting a natural flow into the repo markets. Bond shorting, while that sounds like something which can raise eyebrows and regulators will say, what's wrong with you? It's actually a great way of getting price discovery done. Allow for bond shorting, allow for a securities lending and borrowing mechanism, and along with CDSs and bond futures, it allows for a great amount of depth and price discovery to happen. So it's a belts and braces approach. You need lots of things to happen. The last bit, Krishna, is everybody's fond of saying, you've said a lot of things. Tell me one thing I should do to get this right. Unfortunately, there's no magic wand. There is no one thing that you can, gesture hypnotically and everything becomes okay. It's a whole bunch of things that has to happen together. And what we've tried to do in this report is exactly cover each of those belts and braces through all of these put together. Back to you, Krishna.
Thank you, Mr. Ananth. So yes, we need to address every bit of the market, and very important for having bond forwards and even shorting positions for the price discovery. And hope the regulator listens and allows all the things, that is all the instruments to be developed holistically for the market to become more deeper. Moving on to, what the issuers face in India, from what I have seen with most of the issuers is that a lot of them are not able to access the market when they need the most. And they are actually, working around the regulations to go offshore and things like that. So what is the most efficient way, Mr. Srini, that credit-worthy multilateral institution can provide a credit guarantee for corporate borrowers in India or offshore to raise borrowings, and they help in elevating the ratings as well of these issuers? So what are your thoughts on that, Mr. Srini?
Yeah, thanks, Krishna. I guess we can probably start off with the wide aspect of sustainable development goals that India as a country is aiming for. If you look at the financing gap, each year we are looking at about 117 billion that is required to tackle all the SDG related requirements. But currently the latest data is about like 1/10 of it is what is flowing at the moment. Now, naturally, given the population and the requirements we have, there are ways we have to think about, how do you mobilize this debt capital market at scale, not necessarily in a sector-based approach, which is what we normally do. But if you take society as a whole, the SDG framework slightly changes to what the ESG framework usually says in the Western world. ESG is very much geared towards, if you have a very typical corporate environment, you have a governance, you have certain environmental responsibility for the corporate, along with the social responsibility, which you do as a part of CSR activities. So it's a very siloed approach of ranking a particular corporate when it comes to issuing or investing into a bond. SDG takes a slightly different approach where it takes the country as a whole system. And within system, if you take food as a system as an example, you have natural resources that you'd like to sustain. You have water you would like to sustain, and then you have all the players who are operating in that ecosystem to sustain as well. That's collectively what we call SDG impact. Now, you can translate the same to the likes of health, education, for example. So that's 17 buckets that you see in SDG is predominantly where the multinational development banks really focus on. So as of now, the MDB's strategy has been, you take a particular sector, you find out what kind of guarantee structures that I could do to mobilize private sector at scale. So the typical guarantee structures they normally think about is, if a particular institution which is coming to the bond market or private debt transaction, what's really their credit worthiness as of today without any guarantee structures in place, and where we can actually mobilize a public-private sector partnership. And that there are plenty of examples you can see in ADB portfolio. You have EBRDs, which have been working with the European Commission to see what kind of guarantee structures they can do. So in many ways, they're all like first loss guarantee type of structures where up to a certain amount of loss they can absorb as a development finance corporation. And then the private sector investors, whether you take a senior debt position, for example, or in some cases subordinated debt, you can work hand in hand to actually make an impact. So that's the most common approach that we see in most of the development banks, along with the private sector institutions. Now, there are few innovations that's happening in what's the role of an insurance sector to also come and play a part of credit guarantee structures. If an institution is underrated, where it's not a AAA rated company to come to the bond market, there are ways you can actually think about what are the underlying risks that you have, which is traditionally how the insurers view a particular financial instrument. So in this case, you divide them into a political and commercial risk that you have, which is inherent within a company's balance sheet. Then you have a trading or currency risk if the exposure is sitting in the foreign countries. So you can pick and choose what type of project that you are looking to invest and what type of risk transfer strategy you can build. So that means, especially in India, we have SEBI and IRDA got two separate regulatory structures right now, but there are ways we can think about blending these two structures if they are willing to cooperate and work together. And GIFT City provides a very good example of actually blending these regulators together and start to tackle these problems. So they are the most common ways you can think about. Obviously, the biggest kind of bottleneck that we currently have is how much the issuers are aware about these particular market instruments in the first place. Now, one thing is we among the community talk about all the financial jargon and think about this, but the other thing is if you speak to a value chain company who got an excellent EBITDA, especially in the food value chain that we come across, the main challenge they have is predominantly family-oriented businesses who's never really had the option to tap into equity market or bond market. Then there comes a stage where they can't grow any faster because the working capital requirements becomes really big. It's those awareness that you actually bring to the table on how can they access the private debt market and the bond market. there's a lot of work that you can do purely from education point of view. UNDP has done an excellent job in India, which is a good example. But if we can mobilize a lot more on the education aspect of how do you tap into the institutional market, structuring becomes less of a headache for us as a community.
So yes, Mr. Srini pointed out, there needs to be awareness about what's available out there, and also what kind of structures some of these corporates with good EBITDA can use to access the market. Moving on to, again, the corporates. We've seen most of the Indian corporates in need of money accessing the global capital markets, especially last year when the funding dried up in India. Now, in the external commercial borrowing rules, there are some hurdles. The pricing cap is 450 basis points plus LIBOR, and also the end use rules are very strict. So, Mr. Govindan, how important is it to ease the external commercial borrowing rules, especially on the pricing front, end use restriction, minimum average maturity, so that issuers can tap the much needed market when they are having a fund requirement?
Yeah, I think with the $600–700 billion of reserves, I think they can let go of some of these rules. Most, if you look at it, there is a broad companies, everything is gone global, cost structures have gone global. In that context, many Indian companies do import, export. It's become pretty complex business environment. So international capital should be made available, not with too much of restrictions. If you, let us say, if you look at to talk about Korea, hardly any regulations, only $30 million, above $30 million, you have to tell the central bank that I'm going to do a borrowing of $30 million. That's it. That's a rule. Nothing else. Here we have got a lot of complications, end use, restrictions, and all of that. With $650 billion of reserve, whether we need to do that or not is a question. I think it should be relaxed. And the other major problem is that you don't have access to, I think, smaller companies, like very large companies which are very highly rated with a lot of international exposures. They're able to borrow, right? Like a AAA company in India will probably be able to borrow certain at certain cost, and within the pricing guidelines it would be possible. But once you go one or two steps lower, let us say, can a AA company borrow outside within the ECB cap? Not possible. Won't be possible. Tenor is too long. Expectation of tenor is too long. For that, that sort of pricing is not good enough. Logically speaking, you at least a single A company should have the ability to borrow. The single A company, if they can borrow at, let's say, 650, 700, 800 basis points over LIBOR, if you have to have a cap, you'll have to have a cap which is equivalent to a single A rated company in India having access to outside. Of course, we can always find ways to credit enhance, because I think Srini was talking about some sort of credit enhancement. There is a possibility. We can always find ways to do that, either from international institutions or for domestic institutions. We can have that credit support. That's an add-on which should be. But unless you have even single A companies having access, the whole concept of bond market will be a limited services affair. PSUs will be able to borrow because of sovereign guarantee, and then you will have highest quality, which is like basically Amazon and Google will be in a position to borrow. Indian subsidiaries of Amazon and Google will be able to borrow, and very little space will be available for anybody else, right? So you need to have both the regulation in terms of end use, tenor, working capital. You can borrow for 10 years if you have a 10-year. 10-year, very difficult to borrow. I don't think more than one or two transactions from one or two institutions able to see from India in a 10-year bond. I don't know. I mean, some of the, you know, the companies I'm talking about, very few transactions happen because we're restricted so much with a tenor. We looked at 10-year tenor for very difficult really to look at the combination of tenor, end use, and pricing cap. It doesn't work out even for high quality companies. It doesn't work. It doesn't give any flexibility in any format in the capital structure which we have to manage. So a lot of with $700 billion, why can't we let it go? I mean, basically, why do you have to have so much of restrictions? Yeah, I understand. I think there may be some anti-money laundering, some sort of money movement, all that they may be worried about. I think they can have certain other processes with the introduction of GST and so much of transparency is happening in the economic system. Some of these old rules that people, that back money will move from here to there and there to here and transfer pricing, things will move, money will move easily. Those rules don't, I don't think they are relevant anymore. This is very antiquated rules at this point of time. So we think there should be a wholesale change.
So yes, as Mr. Govindan pointed out, that's the need of the hour. We have seen a lot of issuers use complex structures and offshore SPVs based in Mauritius and elsewhere and work around the ECB rules and raise bonds. But yes, it would be very simplified for issuers. Moving on to green issuance from India. Mr. Shrey, we've seen the highest green issuance from India, and now India is catching up with the global trend. Every company is looking at doing a green bond in India. So can there be an added focus on ESG? We also saw the first social bond out of India by Ultratech Cement earlier this year, just to name the company. And then there are several others which are also lined up. Recently, HDFC Bank spoke about doing a green bond. So in terms of the green issuance, sustainability linked bond, what can be done to promote these companies and create investor and issuer awareness to probably list it on the London Stock Exchange? Mr. Shrey, if you can shed some light on that.
Thanks, Krishna. And for the benefit of the audience, I love this discussion because it gives you a flavor of the discussions that we actually had in the working groups and the reason why we presented the recommendations as such. So to Ananth's point around developing the ecosystem and the need for CDS market to develop, it's not only a domestic issue. I think it's an international issue as well, with more FPIs investing into NCDs, rupee-denominated NCDs. And if GIFT City is a mechanism, I think, for international investors to base themselves, there is the need for market infrastructure to create the products to be able to hedge risks for the investor. It could be one side, for the issuer, it could be the other side. To your question, Krishna, on green issuances, unfortunately, everything is interlinked, right? You can look at green issuances by saying, is $1.5 trillion of ESG-linked bonds now available globally? So $1.5 trillion, and you're talking about $4 billion of issuance in India. Now, comparison to the size of the Indian economy, we feel that there's an element of something which is being missed out, right? But it all stems from the ECB guidelines. So if the issue is allow for a wider range of issuers to be able to access markets, rather than the report mentions, the top 40 Indian issuers have made up 89% of the capital raised in international markets, right? So you want to diversify the range of issuers who are coming to the market. You need to incentivize structures like credit guarantees so that entities like IFC, like EXIM, like and ADB can allow more issuers to come to the market. And you need to raise awareness. To Mr. Govindan's point around end-use proceeds liberalization, now within the ECB guidelines, there is a negatives list which allows for areas where use of proceeds is allowed and areas where they are not allowed. There's still some ambiguity around things like affordable housing, which is a social as well as infrastructure sector which is hungry for finance. So the recommendation that we've made in conjunction with liberalizing the end use of proceeds, and liberalize, I think, is a word taken in a negative context. It really is make it easier for a wider set of projects to access international capital, is for any use of proceeds for a green, social, or sustainability bond, for a pilot period within the ECB guidelines, liberalize the policies. Now, there's a second question which is begging over here as to who then ensures that the proceeds are used according to what is a green project, what is a social project. There are international guidelines for this. There are guidelines that we implement at the London Stock Exchange for it. India is developing this as well, and I really think that if this is implemented, then it's an additional tool to ensure that a wider range of issuers which are come to the market. And then finally, Krishna, to your point on sustainability-linked issuances. Now, this is a new product, right? It's a general corporate purposes product. It applies on your balance sheet as a whole, as long as an issuer can frame what is its ESG strategy. And you saw Ultratech Cement come to the market earlier this year in this format. So now what the market is saying globally is you don't even have to identify specific projects for you to fund yourself in an ESG format. As long as your corporate strategy can say, this is the way that I meet my Paris goals, this is the way that I'm moving towards a model which is less climate intensive than before, you can fund yourself through global markets from that. And then it begets the question, then how does an issuer navigate the ECB guidelines to issue such a product? Which is why, again, our recommendation comes in place. If you want to put a focus on ESG issues, create some guidelines for ESG and sustainable investment.
So as Mr. Shrey pointed out, obviously we need to include this in the ECB guidelines because every corporate is announcing that they are having a sustainable focus within the company. Moving on to the onshore market in terms of ECG, this question is for Lakshmi. There are hardly any issuers raising green bonds in India. Only 2 issuers this year. We saw one smart city do it, Ghaziabad Nagar Nigam, and then recently this week we saw a green issuer by Vector Green Energy, and it was after a very long time, after 3 years of renewable companies doing a green bond in India. So when I talk to mutual funds, most of them tell me that they are just buying this product because of the AAA rating and not because of the ESG credentials. So what are the hurdles there, Lakshmi? Why are issuers not raising green bonds in India, and why are investors not there?
Krishna, if I give you this answer in, from a foodie perspective, the world is moving vegan. So they are having tofu, where in India, people barely eat cottage cheese or paneer. So, they're just kind of arriving at that level. What I mean by that is, ESG as a norm outside is now become non-negotiable, which is why, you are seeing an incremental, rush towards launching ESG-based funds, equity funds in India. So globally, if you see over the last 3 to 5 years, this category has been growing 30% plus compounded. And if you assume just half that pace, you will still cross a $50 trillion mark as far as these AUMs are concerned. But look at it from an India perspective, the total size of the, I would say the mutual fund industry in India is close to $400 odd billion, which is split 50-50 between debt and equity. And out of the $200 odd billion worth of equity mutual funds, there are just more than a dozen of equity funds which are ESG based, and the total assets are close to $3 billion, little under that. So that has been the first step towards ESG consciousness. So I think the way to proceed in India, therefore, will be 2 levels. First is the ESG consciousness, which means you will see many more asset managers. And I did discuss this in one of the working groups that we at Kotak are one of the first signatories to the UNPRI, not only on the equity side, but also on the fixed income side. But that does not really mean elimination. That actually means engagement. So that is going to be a first step. And the second step, as I said, is, you have to have a slightly broader investor base to be, to be able to take, homage to these kind of bonds, because look at the nature of the mutual fund industry, the liability. We don't really have asset liabilities, but our investors who invest with us, that is our fiduciary money that we manage. But that money can just, go out like a spring. You just release it and the money is out. And imagine I would be hunting for a vector to actually support these funds. And how do I really manage the gaps? Because issuances could be longer dated, because these are all longer tenor projects, whereas this particular issuance was a shorter one at 3 years. But usually you've seen longer tenor issuances. So therefore, mutual funds may not be the right audience unless you have the right kind of funds. So yes, we also as an industry are working with the regulator to probably allow thematic funds within the fixed income category that can allow for more such category funds. And that also means that the audience appeal will be significantly different. Why do you think that, this last quarter gone by, or this period has seen so much of rush of Indian issuers raising green bonds abroad? That is because the underlying criteria of that investee entity, or the investing entity, is that, look, this is a prerequisite. So that's not really happened here now in India, and therefore the same set of investors are probably issuing the plain vanilla bonds, and they are able to have their funding requirements raised. So I think there is a clear-cut case for a particular category which can make this particular particular entity called the mutual fund industry is slightly more active over and above the banks, probably which are already investing in such kind of bonds. So it has to be a two-way process to ensure that this kicks off and sustains itself, most importantly.
So yes, India is taking some baby steps, as Lakshmi mentioned, and her fund is also looking at this category. And moving on to some of the smart cities. Obviously, India has a big target of sustainable cities and smart cities, and most of them are in requirement of funds. So, Mr. Srini, can the Indian smart cities tap the Indian diaspora in UK by raising, say, diaspora bonds or masala bonds? Obviously, 3 years back, they were very famous and no Indian companies issuing masala anymore. But going forward, should there, can there be such a thing? And should there be a special tax treatment for such investors, Mr. Srini?
Yeah. So when it comes to the whole smart city initiative, I wanted to take a two-side view. One is the issue of view where in India, naturally, smart cities and the what you call tier 2 cities have seen tremendous growth compared to what you see in many parts of the world, partly because there has been initiative among the demographic to shift away from the major cities into the tier 2 cities, which demands the municipalities and governments to slightly take a different approach on how do they create the infrastructure. So from a demand side perspective, there's a lot of initiative that's been coming out, especially in major cities. These initiatives are only growing in the last few years. But if you take from an investment point of view, in the municipalities themselves, as you probably know, have a lot of rating issues compared to corporate companies that you see in India. So on the demand side or on the issuer side, there's quite a bit of work to be done to see which municipalities and which smart cities would actually be able to tap into the market easily. So there could be some sort of a grading to see a smart city right next to Bengaluru is well placed to actually attract the capital compared to, let's say, Madhya Pradesh, which is very much a large agricultural state in many ways. So that element of work to be done on the issuer side, which becomes very important. When it comes to the investor side, globally, India is one of the largest countries when it comes to the diaspora community. And UK has had a lot of remittances towards India. I think the quote was about $4 billion, which is what remitted back to India as the latest figure. Now, what really incentivizes an NRI community, people who are from Indian origin, to send it back to India? Majority of us, as you probably know, there's a element of property investing, which actually, drives most of the kind of overseas remittances in many ways. The second is there's a deep-rooted connection that we share with India. No matter where you live, you always carry it in heart. So that means when they actually look at investment, they still basically look at the economic incentive of investing, which traditionally is the risk-return trade-off that you do compared to what you invest in this part of the world. But if you look at the bilateral transaction, the tax incentives really is no different to what you do from a charity financing point of view in this part of the world. If you do put money into certain charities, then you have tax incentive that you can actually get it from the HMRC. But it requires both government to recognize that this community really want to do not necessarily charitable, but it's more of a good sustainability cost. So the bridge between the charity finance and the sustainable finance has to narrow, in my opinion. And that allows us to actually treat the tax incentives slightly similar as you do for other initiatives that you contribute in this part of the world. Now, the biggest challenge in diaspora bonds in the past, Israel had a lot of success behind crisis. 1967 had a great success. Nigeria did like a bond which has been subscribed fairly above what they actually originally asked for. The biggest problem still has been on the marketing cost involved, because you need to market in two ways. You need to market on the issuer side. At the same time, if you're tapping into overseas investors, at least the NRI population here, what is the real marketing cost involved in bringing these bonds to actually raise money? I think the numbers quoted were about 4 to 5% of the total issuance. That simply is not sustainable for you to actually bring a bond to the market, really from a marketing cost point of view. So if we can think about the cost structures involved where there's support from the public sector available to actually market it out, and then the tax incentives, they can still operate at what you call a smaller level. So if a bond issuance is about 100 million, diaspora could simply plug in the kind of what you call the first loss guarantee type of structures where they can do a small contribution. I don't necessarily see them actually filling the entire pool, because you still need like private sector and senior debt guys to come in. But in this case, I think they can actually come in as a part of what do you call a subordinated debt areas or the credit guarantee structures. I think they have a significant role to play.
So as Mr. Srini mentioned, yes, we need to do something about the marketing cost and also get in interesting structures so that, obviously the issuers can access these markets. Moving on to the last question, that's for Mr. Shrey. Can the reduction in withholding tax to 4% for offshore bonds, which are listed on GIFT City, can that be extended to international centers like London Stock Exchange? And can GIFT City be developed as an intermediary between India and London? What are your thoughts on that? You're on mute, Mr. Shrey.
Yeah, if I had a rupee for the number of times that's happened in the last year, I think I would be a crorepati. But the question has come up in the Q&A asked by the audience as well, and one of the questions was the GIFT City idea doesn't work until there's an entire financial ecosystem. And to I think Ananth's points earlier, the IM I think is now hot in terms of the IFSCA regulator has been set up. There is an ongoing body of work which is being done within the India-UK financial partnership to consider how GIFT City can effectively be that center for regulatory convergence. And because there is a unified regulator, there's the ability for each of the recommendations in this report effectively to be incorporated into a new set of rules, allowing issuers to raise capital within GIFT City and international investors to put their money for capital raised through securities in GIFT City. However, the shortcoming at this point of time is that the new withholding tax regime in GIFT City, because it's about a sole listing in GIFT City, has been used only once. So in terms of demand, we certainly feel that there will be more issuers who access this mechanism if there is the ability to consider an international center with regulatory convergence like London to have a co-listing with a GIFT City issuance and for investors to get that beneficial treatment. Now that requires a little bit of work to be done in terms of what the exact mechanism is, but we as the London Stock Exchange are in touch with our counterparts in India, whether it be the NSE or the BSE, to explore such mechanisms, and we're looking to explore that further as the recommendations of this report are taken. Just one final point on the point on diaspora bonds. I think the one time that the London Stock Exchange and the UK financial community has managed to fill out Wembley Stadium was when the Honourable Prime Minister announced rail bonds, rupee bonds. Brook bond, James bond, rail bond, rupee bond is what I remember. But it's the significance of the community which exists over here, and also the ability to market in smaller sizes, right? So there is a route to be able to market your bonds in smaller denominations if you provide the right disclosure and if you file the documents in the right way. And certainly with the interest in the fintech community to be accessing markets in a greater manner. I mean, in the UK, there's going to be a green savings bond, which is done as part of the first green gift. I think it's a sea change in equity markets and debt markets in terms of us, people on the street, buying bonds and holding them in our portfolios. So Ananth aptly put it, the iron is hot, and we certainly think there is appetite to pursue this further.
Yes, so I guess India needs to introduce more products, and there will be demand from the Indian diaspora abroad. There are a couple of questions from the audience. I would like to ask this question to Mr. Ananth. Regards to the tax treatment for equity and debt. The question is, if equity and debt are brought to the same level, then will the equity market get affected negatively? That's the first question. And the next question is on the same line, keeping the debt and equity ratio at the same level with the enterprise value diminished. So, Mr. Ananth, you can share your thoughts on this dilemma with the investors.
So first, like a good professor in an MBA college, I have to tell you there are no right answers. There are only viewpoints and perspectives. But I'll give you my viewpoint and perspective on this. One is, Lakshmi is here and she's an expert. when you do asset allocation of your personal wealth and savings, you do it across asset classes, you do appropriate amount of debt, equity, commodity, Bitcoin, whatever suits your fancy. These investment decisions should not be guided by taxation considerations. Ideally, if you're choosing equity because it has a better tax treatment than debt, you're choosing it for the wrong reason. It should be based on the risk and the return profile of an asset class rather than tax considerations. To that extent, if you have a skewed taxation policy which favors one asset class over the other, you are upsetting the asset allocation strategy of investors. It's a controversial topic. I can already imagine some 10 people beating me up, but I'll put it there anyway. What was the second question? Sorry, Krishna, I'm growing old. This was about the, again, something to do with tax.
The diminishing enterprise value if debt and equity are brought at par.
So I'm going to refer to, again, an academic paper, Miller-Modigliani, which basically says enterprise value does not change depending upon the capital structure, whether it's debt or equity. It's equivalent. The enterprise value is equivalent. There's a nice paper around that. If you want, I can send you the link to that particular paper. But the broad point is the following. I think a lot of us choose equity as an asset class today for a couple of wrong reasons. One is interest rates are too low, and that too post-tax interest rates are extremely low. So therefore you go for riskier asset classes. And second is, of course, in the case of debt, it is definitely tax plays a big role along with the level of the interest rate itself. My point is that's not a healthy decision point for choosing equities. But yes, I sense the angst. One of the big discussions we had in the working group was if you ask for equilibrium between debt and equity taxes, what the authorities will do is lift up tax rates of equity markets to that of debt markets. That's not what we want. We want the tax rates of debt to be brought down to the equity level. But it's a good question. We still think that tax should not be a consideration for choice of asset class in our savings portfolio.
Well put. So we'll end this discussion with final thoughts from each of the panelists on what is the need of the hour and what can be implemented in the most efficient way in the coming days so that we have a very vibrant and a deep capital market from the bond side in India. So we'll start with Mr. Govindan, and each panelist can just give one line what you all would like to see out of this report. Although many things are recommended, but what's the need of the hour?
Yeah, I think we need to do lots of things. I don't think there is one thing which can be done. I think it has to be done in a holistic fashion. Then it will work. You need to give freedom. You need to trust the companies that they will do the right thing, not over-regulate. I think keep it freer and slightly lesser cumbersome. I think the link between the international capital and the domestic, I think the link will be there, and business and financial links will get stronger. I think the world will be better off with this thing. I don't think there is only one single suggestion which will change the world. Not possible. Unlikely, in my opinion.
Over to you, Mr. Jayesh. Any final comments?
Yeah, building upon my earlier point about greater coordination among the regulators, one interesting thing about the Indian market is you have these large number of long-only investors who are literally hold to maturity. Now imagine if they were to start doing trading and trading from purely I'm not saying as an official market maker, but trading because of price anomalies or credit risk pricing anomalies or what have you, etc. But we need therefore a mindset change as far as the insurance regulator, the pension fund regulator is concerned. And the earlier point about how do we get the trade-off between, say, social and ESG, etc. How about coming up with some norms where you get given, there are a large number of pension fund schemes, etc., which are still not really accessing the bond market. So if maybe creating a mechanism where they get an additional, say, return, which is, I don't know where it comes from, but some structural change being made, because we have these pools of capital lying around, which otherwise by default only goes in the government securities and is not coming to the corporate bond market. If you can create a bridge out there, that'll be great.
Lakshmi, over to you. Any final comments?
So Krishna, I think the report is like a recipe book. So the recipe has all the right ingredients. The chefs have put in their heart and soul, which is all of us as members and the others. I think it's a matter of time that the microwave needs to be set, which is obviously the regulatory and the other infrastructure requirement. And while we're doing all of this, we just need to be mindful that too many cooks spoil the broth. So that's it.
That's a nice way to put it. Mr. Ananth, any final comments on what you'd like to see?
Again, you put me after Lakshmi. Yeah, completely unfair. No, but I think Lakshmi did extremely well. And I think Mr. Govindan said it well as well. I think all of us, a fantastic conversation. I really learned a lot as well. The point is, I think there can be no doubt that we need to garner savings towards productive investments, both domestic savings as well as international savings. To that extent, this is the right time for us to try and deepen the debt capital markets. This effort has been made before. Good progress has been made. We shouldn't beat ourselves too much, but a lot needs to be done. And there are multiple areas to be covered here. To start with, the depth in the primary and the secondary markets, the point about some kind of regulatory intervention in repo and into corporate bond markets, into secondary markets, the concept of a market maker, which I'm very excited about. I think that can have a lot of promise. The whole point about the taxation rules, and trying to build some popularity around corporate bond markets, just as we have, even if we get 20% of the popularity that equity markets have, I think it can be great for the ecosystem. Around that, taxation rules, regulations can change a lot. And of course, all those belt and braces products and market infrastructure, such as, shorting of bonds, bond indices, futures on them, and so on and so forth, and CDS markets, to try and build that entire ecosystem, along with all the points that Shrey and Srini and Joyvin made about what's required from the international side. It's a whole package. Even if 50% of this gets implemented, I think we'll see significant progress in our dream of seeing Indian debt capital markets fund our growth aspirations and our immense growth potential.
That's a very good way to put it. Mr. Srini, and after that, Mr. Shrey, any final comments from you all?
Thanks. So one of the areas we all seen like together is in the last 10 years, we've seen crisis after crisis, right? You got economic crisis, and then in Europe, there was a political event in 2016, which, UK took like 4 or 5 years to resolve with the EU. And then now we got pandemic. And one good thing about crisis is crisis really teaches us harsh lessons on where we are prepared for and what we are prepared for and how we're going to solve it. And that brings the opportunity. So to me, the way I see it, especially for India, is although we had pandemic, although we had the worst of it, let's say in the last few months, it actually clearly shows that there's a climate agenda which we have, which a lot of global investors are very worried about. There was a very doomsday report which says 90% of India GDP could be gone if you're not careful by 2050. And that together with like pandemic really means we need to bridge the gap between where the equity market perception in India and where the debt market is, without a question. To me, when it comes to the need of the hour and what the report is actually saying, it clearly highlights in global world, you have equity markets and debt markets work together, and the market chooses basically what's the best way to capitalize as far as your business is concerned. So we can converge basically both the markets where there is enough liquidity, there is enough investor participation, and there's more issuers who can actually come to the table to access these markets. Suddenly you're creating these equitable markets on both sides that will really show where the kind of economy can be accessing the capital. To me, that report actually gives all the foundation that we need. So it's definitely a version 1.0 that we kicked off. Moving on, we'll start to actually focus a lot more on various aspects and various sectors. I think that is something that can show what would a construction sector be looking at versus an energy sector versus a food sector in India. I think if we can build on that as a version 2.0, that'd be fantastic with successful issuances.
Yeah, as Mr. Srini points out, yes, this pandemic is the right time to implement some of these recommendations so we can see a vibrant market. And Mr. Shrey, any last words from you regarding convergence of India and UK?
No, I just wanted to say, Krishna, thank you to our working group members, in particular to Mr. Govindan, Vipul and his team at L&T, as well as Joyvin Matthew, who's going to be speaking next from DLA Piper. Anita, Shraddha, and the entire City of London Secretariat team. I don't think this report would have been put together without the hard work of people who sit, behind us and are not seen on the screens. So a big, big thank you to you for driving us through very, very difficult times. I remember March, April, people's minds were elsewhere, and we really, really pulled through. Look, as Lakshmi said, this is a recipe book and has the right ingredients. We're trying to push it through with policymakers, so we'll try and see it implemented. And the last time we had a crisis in the 20s, we had the roaring 20s, which followed. I mean, there was things which happened in the 30s and 40s afterwards. Let's not talk about them. But we had the roaring 20s, and we really want to see, from our perspective, a spirit of partnership between UK and India continue, and for more Indian companies to be able to access more liquid markets, both domestically and internationally. Thank you.
Thank you all the panelists. There is always a silver lining at the end of dark tunnel, and we have been through a lot as a country, and obviously this report will make the market more vibrant, deeper, so that issuers and investors have a happy feeling of owning the bonds and even raising bonds. I'll go over to Mr. Anita for any final comments.
Thank you. I just want to express our gratitude to all our panelists today, and especially to you, Krishna, for driving such a fantastic discussion. May I now invite Joyvin Matthew, partner at DLA Piper, for his closing remarks.
Thank you. Thank you, Anita, and thank you, Krishna. First of all, I'd like to thank Krishna for moderating what was a very illuminating, insightful discussion. I must say this has been of all the webinars I've participated in or listened to, I leave this room having learned quite a lot personally. Even my engagement with the working group in the past months has been a great learning experience, because clearly we have experts from various sectors, various industries, bringing in their expert views to bear in how we could make the debt capital markets in India much more of a robust and a resilient system. I also want to thank all the other stakeholders. For instance, I'd like to thank the City of London Corporation for taking the lead in putting together this working group and working towards this report. None of this would have been possible without the India Representative Office. Anita and Shraddha deserves a special mention for shepherding us along, organizing the meetings, ensuring that work got done in time, and to take us to this day when we are actually launching this report. I foresee a lot of great things, a lot of great discussions, a lot of productive discussions, being held by the stakeholders and the policymakers as a result of this exercise and this report. I'd like to thank the Shrey and Ananth for leading the working group, and also to all the individual members of the working group and all the institutions that they represent for bringing us to this conclusion. Unleashing the potential of the Indian debt capital markets is the heading of the report, and this had various iterations, and we thought this was the most apt, because we had to unleash unleash this beast, if you will, because there's a lot of pent-up energy as far as debt capital markets in India is concerned, and what we need to really do is just to take off the shackles, whether it's the offshore or the onshore markets are concerned, so that the full potential for finance to transform India is realized. Now, there's been 15 recommendations, and the reason why you only have 15 recommendations is to kind of focus the attention of the policymakers, not on a wide set of issues, but just as Lakshmi said, just the right ingredients to produce the great dish, which would be a more robust and resilient debt capital markets in India. Now, there are a lot of themes which emerge from this webinar discussion. One that I especially like is ESG consciousness. We are living in an age and a time where we are actually seeing seasonal changes. Summers are hotter, rainy seasons are more rainier, winters are colder. We are actually seeing the effects of climate change in our daily lives. A country like India is especially susceptible to the ill effects of climate change, and it has to transition to a low carbon economy, consistent with its commitment to the Paris Agreement. Now, we spoke about just 4 billion of issuance green bonds being issued in the offshore markets. But what we really need is ESG consciousness, right, within India. And we need to kind of use the debt markets onshore to bring about, foster a change in the mindset where you issue green because, the population deserves, population wants it, investors need it. We also talked about how it's only a certain category of issuers who have successfully raised debt in the offshore markets. We got to think about the smart cities, the sub-sovereign entities, the entities which would need financing for infrastructure. Those entities need to be encouraged to go to the offshore markets, use centers such as London to unlock global capital, and actually take the next step towards meeting the infrastructure needs of the country. I mean, as far as India is concerned, infrastructure is going to spending in infrastructure is going to make the big difference between what it ends up as in the next 10 years or next 10 to 20 years. So infrastructure spending is crucial. Encouraging smaller issuers who would not have otherwise dreamt of going to the offshore markets is key. We need to therefore allow credit enhancement providers to step in and stand behind those credits. And as Mr. Govindan rightly said, if you have $650 to $700 billion of reserves, there cannot be a better point in time than now to let the market take its course. Let's think about how lower rated entities can raise debt. Let's talk about how matters such as minimum average maturity, all-in cost ceiling, withholding tax, and other issues which prevent issuers from going to the market, go and raise debt from the offshore markets. In many ways, I always say, sometimes when we speak to clients about whether they need to go to the market and whether it makes sense, sometimes the refrain is, oh, we can raise debt from the onshore markets. Why do we need to go offshore? So then one of the reasons, one of the things we always say is, you don't go to the offshore markets just to raise debt. You also go to increase visibility. You're trying to get investor engagement. You're trying to get investors to understand what your credit is like and what your sector is like. So therefore, there's a lot of benefits which the debt capital markets can give to the country and to the economy. Now, the City of London, or the Square Mile, as sometimes it is referred to, can be an important player. It can play an important role as a facilitator and as a partner as India moves forward, right? So I see London is, the City of London is a historic center of London. It's been a financial center for hundreds of years. The next Lord Mayor would be the 900 there's been more than 600 Lord Mayors in the City of London. So that shows how old this financial center is and how deep it is. It is, London can act as a gateway now to unlock the global pool of capital for India. And let's use that. Let's use that opportunity. And I'd like to end by saying that, in as much as we've launched this report, what we'd like to do is to take the next step forward. We've got the ingredients. Let's stir it into a tasty dish, which is going to be a fine debt capital markets, whether it's onshore or offshore for India. We look forward to continuing those discussions with the members of the working group and with the other stakeholders and the policymakers in India. On that note, I'd like to thank each and every one of you for making this event a grand success. Thank you.